Hey everyone, Brian Bogner along with Greg Towner. It is time for our last podcast episode of the 20-minute market breakdown here for 2024. Uh, and as you know, the election's over. The country didn't end. We're still here. Whether your candidate won or lost, we're still moving forward, which is one of the great things I believe that America does. And the market has been moving as well. It's been moving up. It was in an uptrend before the election, and it's continued in that same uptrend. You know, with the market trends at times, it goes up, it goes sideways, it goes down. And so we obviously look at the trend when we're thinking about what we want to invest in. But even more importantly, sometimes what we have to do is we have to look at how healthy is that trend. We kind of have to open the hood, right? So if the market is going up, is it a healthy trend? Are all the stocks or all the securities participating in that trend? What's really happening under the hood? And that's what we want to talk about today, because there's a number of things that we do to look at the health of a trend. We look at market breadth, we look at sentiment. So we're going to dive into that with you for the next 20 minutes, help you understand what that is, and then look at what the market's doing right now in those areas. So, Greg, how are things going?
Things are great, Brian. I'm looking forward to the holidays like a lot of people, but let's first talk about the market status, right?
Let's do it. So let's talk about market breadth. What is market breadth?
Yeah, I know, both of us have kind of a technical
Mhm.
background, and there's a lot of different ways you could look at the health of the market and the breadth of the market. But just a really most simple definition is, how many stocks are going up versus how many are going down, whether you want to look at that each day, each week, what have you. That's just the most basic way of looking at it. And, of course, you generally want to see more stocks moving
Right.
higher versus less. That would be the general positive view of the market, not necessarily what we have right now.
Because we have these indexes that we're looking at, whether it's the S&P 500 or the Dow or the Nasdaq or this, that, right? We have these
Right.
indexes and they're composed different ways, right? And so because most of them are composed market cap weighted, you could have an index hitting new highs and being like, well, there's the market. Well, there's 500 stocks in that index. Does that mean all 500 stocks, right, are making new highs? That's right. That's how we're coming in and seeing and evaluating using this market breadth. So what is the market breadth right now when we look at the S&P 500?
Yeah, honestly, it's quite poor, very
Okay.
poor. Yeah, I mean, we're seeing really just a handful of mega cap stocks, primarily mega cap technology stocks, pushing things higher, as we've seen periodically over
Mhm.
recent years. In fact, I have some data here that was really interesting. Just since the election, you referenced the election, just since then, that's what, 5, 6 weeks now. A growth index is up about 10%, while the value index is actually about flat. The S&P 500, which you reference different kind of indexes, the S&P is market cap, so the big names mean a lot more to it. That's up about 5%, whereas the equal weight S&P is up, just a little over 1%. So big, big differences. And then if you talk about the Dow Jones Industrial Average, every news story
Yeah,
leads off with
sure.
that, right? It's now 9 straight down days at the time of this recording. That's the longest losing streak for the Dow since 1978.
Wow.
Okay. And then we talked about advancing stocks versus decliners. It's now been 12 straight days of having more decliners than advancers. And this is the only time on record that that's happened. And the market, the S&P was actually up during that period. So you can
Yeah.
see there's literally just a few stocks that are up a lot, pushing this market over the last, let's call it a few weeks or so.
Yeah. So what does that mean for us?
I mean, if we look back over time, it means a lot of things. I think historically, a lot of times it's just end up getting rotation, meaning
Hmm.
other sectors eventually, take over to push the market higher, or other industries, maybe even other areas of the, investing landscape. But if we look back at the data, which we did, you know, bad breadth periods are a little bit more likely than normal to have shorter term corrections.
Okay.
Doesn't mean it has to happen, doesn't mean it has to be bad, but it is a little bit more likely as opposed to otherwise. But we'll say, I think right now that's kind of pushing back against that is we're going into, or we are into, a positive seasonal period.
Right.
Stocks tend to do well here the second half of December and into January. Nothing is guaranteed, obviously. That doesn't mean it's going to be the case, but hopefully that's a little bit of an offset for some of the bad breath that we're seeing right now.
Okay, so we've talked about breadth, which is you just mentioned. Now let's talk about sentiment, right? Sentiment is more getting into investor behavior. So how does market sentiment look right now?
I mean, anybody that listens to us knows we talk a lot about sentiment in lots of different ways and everything to do with behavior. Right now, investors have gotten really, really bullish for the most part. Whether that's because of the election or, mostly it's because stocks have gone up. I mean, sentiment follows price. When prices are going up, people get more bullish, rightly or wrongly.
Mhm.
So a lot of different metrics we look at shows that. But one that I found interesting was household allocations to stocks are now above 60%, almost to 65%. Now, that may not sound like a tremendous amount to some people, but it's actually quite rare. The study I was looking at went back, I think, about 25 years, and very rarely does it get up to that high. So a lot of people own stocks. Obviously, part of that is because stocks have gone up so much and maybe they haven't rebalanced. But it's not just that though. It's some of this anecdotal things that we look at where investors, we see articles and hear stories about people getting really, really aggressive. They're chasing some of these, meme coin things and double and triple leveraged ETFs. And we know options trading has set all kinds of new records. There
Right.
was an article in the Wall Street Journal recently about all the young people, trading like crazy. And
Mm.
I'm not saying, trading or a little speculating is all bad. I mean, I think
Right.
most of us have done it at some point. It's just a matter of keeping it in check and doing a very small amount because it's literally gambling. And we know how, gambling usually ends up for most people. So,
Yeah, I mean, it's kind of like when you go to some holiday parties right now and things like that, what are people talking about? You're hearing more and more conversations from people that normally don't invest and they're talking about their
yeah.
crypto and all this other stuff they're now doing that they weren't doing 6 months or a year ago, that's usually a sign that things are getting overheated, right?
Yeah, absolutely. And but one thing I'll say about sentiment is number one, it's really only most useful when it's at really stretched levels. And of
Right.
course, it's hard to know exactly when that most stretched level is. I get the sense that maybe there's a little more upside potential to the sentiment just because it's concentrated in certain areas. But also, maybe more important than that, different data that we've looked at, sentiment is not quite as useful a tool at extreme highs. In other words, the greed side of the emotions versus the extreme lows where there's real fear. When people are just like, oh my gosh, sell everything, get me out of this. I'm in desperation mode. That's usually a really good sign. When people are greedy to the upside, it's probably ultimately a bad sign, but it's harder to judge because stocks go up over time.
Yeah.
So, yeah.
Yeah, when there's blood in the water and and everybody's out and no one wants to touch the stock market, that's usually, a very, very good time to start buying it. We just haven't had that
No.
since 2008, 2009. It's been a
Yeah.
while, right?
Right.
What are some data points you have on sentiment here?
Yeah, I mean, as we kind of look out, so that was more of a current day sentiment view. But
Hmm.
I found some data recently that was really interesting, and it's partly sentiment and partly just kind of how people view investing in general that really kind of opened my eyes. So this is a study that the Federal Reserve Bank of New York apparently has been doing for 20 to 25 years now. And they survey people asking, what do you think the likelihood is that stocks are higher 1 year from now? Not up 10% or 20%, just higher 1 year from now. And only about 35 to 45% of people responded that they think stocks will be higher 1 year from now on average over this
Right,
time
right,
period
right.
of this study. And that just was amazing to me because we've looked at the data. The S&P historically in any 1 year period is positive about 75% of the time. So roughly it's up roughly double the amount of time that people
Right.
expect the market to be up. So the people, if they're investing like that with that kind of negativity, it's a real negative for them. And that's just one
Right.
year. I mean, if you go out
Right.
to a 10-year time frame, 94% of periods stocks are up. So yes, sentiment is probably stretched here in the short term, but I think it's important for us in the industry to remember that, investing in general is still not something that's super comfortable for some
Mhm.
people, and they have a view that stocks aren't up that often when in reality is quite different.
Yeah. Yeah. So we've talked about market breadth. We've talked about sentiment. So what do we, right, as investors do about all this? We say this a lot on the podcasts and the videos that we do is to ignore the noise, right? Ignore all of the noise and the messages and the headlines and all those things out there. Okay, they're generated to get clicks. They're not generated to give you information that you need to make informed decisions. Ignore the noise. I think the second thing we need to do is focus on your financial plan, right? So if you are investing in a portfolio and you don't have a financial plan, you are missing the mark. You need a plan. And what happens is your portfolio comes along and complements the plan and the goals of what you're trying to do. Okay. So you need to focus on that plan. And then lastly is maintain a diversified portfolio of high quality assets. When I talk to people about diversification, what that means is, if you were to take all the returns and all the different asset classes, things like that, it means you're never going to be at the top. But guess what? You're never going to be at the bottom. You're going to be in the middle. And and diversification usually means, well, I wish I'd have bought more of that, right? It rarely means I wish I would have bought less of that, but it usually means I wish I would have bought more of that. And that's okay because that keeps us on track, eliminates a lot of volatility, especially if we own high quality assets, which we do here at Parallel Portfolios. So if you have any questions about what to do about anything that we've talked about, give us a call, shoot us an email here, and we'll be happy to sit down with you and go over this in detail. So as we get to the end of this episode, usually we talk about some recommendations. I'm going to go first and let Greg close us out today. But my recommendation to you is simple. We've had a crazy year. The election is over, and thankfully, whether you voted for this person or not, the person that won, and we knew the next day, and we were able to move on. So, and the country's still moving forward. So enjoy the holidays. Take some time, turn the TV off. Well, unless it's football, of course. Turn the TV off. Focus on some friends, family, and those things that really, really, really matter this season. Greg, what do you got for us?
Yeah, thanks, Brian. We've referenced, quality a couple of times in this podcast. And of course, we were referencing quality stocks and investments. But I'm going to open that up here. My recommendation is just to buy quality in general across everything. Of course, your investments as well, but throughout your life. I've heard people talk about, if you have trouble figuring out what to buy people for Christmas, buy something really high quality that they use every day that maybe, upgrade an existing item that they have.
Mhm.
It's a quality, or maybe everyday item that you use, you want to upgrade, or a service of some kind. Quality, it might be a little more expensive, perhaps, it often is, but it's going to last longer. So maybe it's going to be cheaper in the long run. It's going to be less apt to break. It's going to be less stressful. You're going to be able to just have a better enjoyment and a better experience owning quality, whether it be stocks, items, services. So buy quality across the board. That's my recommendation to everybody right now.
Well, thanks, Greg, and Merry Christmas and Happy New Year to everyone. And we will talk to you next year.